stocks struggling to snap a losing streak as investors navigate macro uncertainty. Joining me now on set, we've got Kevin Mahn, who is the Hennion Walsh CIO. Great to have you here in studio with us.
Great to be here, Brad.
An important day for you to be here in person as we're kind of tracking the slippage here. You're actually warning about the potential dangers of trying to time the market.
Yes.
Explain how you're viewing the recent volatility and what investors need to know.
Sure. To start, prior to yesterday, the VIX, which is a measure of volatility in the market, rose by 35%. And that caught some investors off guard. And you know why? Because last year there was little to no downside volatility, as there was less than 4% of the time the market closed 1.5% or more lower on a given trading day. That's a historically low level of volatility. But that type of volatility shouldn't cause investors to flee the markets or try and time the market. You know, Warren Buffett once said, and I agree, that the Hall of Fame of market timers is an empty room. Trying to time the market is an exercise in futility, because you got to get it right twice, Brad.
Right.
When to get out and when to get back in. It's when to get back in that is often more difficult and allows investors to fall short of their longer term financial goals.
Right, and so that's where we hear this old adage, it's not timing the market,
Oh, yeah.
it's time in the market here. You know, how can you really make sure that you're allocating your assets for any market volatility that you have to weather?
Sure. I think you need to stay true to your risk tolerance. In other words, your risk tolerance shouldn't go up just because the market is moving higher, just as much as it shouldn't go down just because the market is moving lower. Build your asset allocation strategy consistent with your personal risk tolerance, your investment time frame, and ultimately what your growth and income goals are. There was a study done by a University of Michigan professor, and I recognize this study is somewhat dated, but he looked at 31 consecutive years of stock market returns. And what he found, Brad, was that 95% of the stock market returns come on just 1% of the trading days. Now, I don't have a crystal ball. I don't know when those 1% of the trading days are going to be, but rest assured, if you're not in the market on those 1% of the trading days, you're likely to miss out on the most significant returns the market has to offer, and they generally come after big down days.
With all of this in mind, for some of the slippage that we have been tracking here, a lot of investors trying to figure out where they should be reallocating.
Yes.
And you have, I think, trending on social here earlier this morning, I had seen even buy the dip.
Yes.
So if you're talking to investors right now who are trying to figure out what dips feel safe or which dips actually might have a little bit more of a dippity dip coming in later on here. It's a technical term.
Yes, absolutely.
Yes.
So I would look into those themes that are going to continue to resonate in the new year, or perhaps even over the next decade. I know the AI revolution is being called into question tomorrow. I think we'll find tomorrow afternoon, after NVIDIA reports that the AI revolution is indeed alive and well, and CapEx spending will continue there. But don't just look at those semiconductors and chips plays. Recognize the other opportunities that exist around there. How about power solutions, utility companies, SMRs, nuclear capabilities, or even the data centers, the cooling solutions for the data centers? I could go on and on. There are growth opportunities ahead. However, we're starting to see changes in market leadership now. We're seeing value outperform growth, international outperform US. Maybe now's the time to take some chips off the table and move into other areas of the market that may provide the leadership going forward.
As we're thinking about some of those attractive areas of the market, what are you playing, what are you fading right now?
So where I really like right now, I still like the utility sectors, particularly multi-utilities that pay good dividends, have strong balance sheets, and supply electricity, natural gas, and even nuclear power capabilities. I think people are shorting defense right now. I don't think defense spending is going to decrease as much as many anticipate. If you look at companies such as L3Harris or even Lockheed Martin, I anticipate more spending in those areas ahead. And then you go away from that. How about small cap biotech? If you're looking to be a little bit more aggressive and looking for growth opportunities, I bet you there's a pickup in M&A activity, and the small cap biotech companies will benefit from that.
Kevin, thanks so much for joining us here.
My
Critical
pleasure.
day to get some analysis here and get some insight. We appreciate it, Kevin.
Thank you.